So you've heard of the broad term financial statements, and you're wondering, what are financial statements? How do you read financial statements, and what are they even used for? Well, in today's video, I'm going to be explaining 3 financial statements that all business owners need to know. And in the video, I'm also going to be giving you some tips on how to assess your business's current financial health. So make sure you stay until the end of the video. Welcome to my channel. My name is Irene, and I post videos explaining important accounting concepts using simple language to help business owners gain financial clarity. Make sure you hit that subscribe and like button. All right, let's get started. Financial statements are a set of accounting reports that summarizes a business's operations. The purpose of financial statements is to give the reader an idea about the financial health of a business at a glance, which they will use to make informed decisions. So for example, you, the owner, you might rely on the financial statements to determine if you can expand product lines or if you can increase the budget next month for ad spend. Another example is for creditors or lenders. They might rely on the financial statements to assess if they want to give you more money. So the first financial statement we're going to be talking about today is the balance sheet. The balance sheet summarizes all of a company's assets, liabilities, and equity at a specific date. So assets are anything a company owns in order for it to produce income. So for example, let's say your company holds inventory. Your inventory is considered a current asset because you intend on selling the inventory soon so that you can generate income. Another example can be equipment for your construction company. These are considered capital assets because you have to use the equipment in order to carry out the construction duties to generate income. Some other assets can include an investment portfolio so that you can collect investment income, or rental properties, which will allow you to collect rental income. Liabilities are things that the company owes and they are obligated to be repaid sometime in the future. So an example of current liabilities could include your credit card bill that has to be paid soon, or payroll withholding taxes, or sales tax payable to the government. Some longer-term liabilities can include a loan or a mortgage on a rental property that you used for the company. And then equity is basically the residual value, which is when you take all the assets and you deduct the liability. Okay, so now that we know what is on a balance sheet, how do we use the balance sheet to assess our financial health? Well, for the balance sheet, we can calculate ratios to kind of measure how liquid a business is or how leveraged a business is at a specific date, right? So one of the most popular ratios is the current ratio. Current ratio is calculated as current assets divided by your current liabilities. And basically this will tell you how much current assets you have in order to meet your current obligations. So for example, in your bank, you have $10,000 at December 31st. So that's your current assets, $10,000. And then at December 31st, you have a credit card that's payable for $5,000. And so your current liability will be $5,000. So when you take 10 divided by 5, for easy math, your current ratio is going to be 2. And what that means is that for every dollar of current liability you have $2 to pay it. So that's pretty healthy, I would say, but it really depends on the industry that you operate in. It has to be compared to your industry standards, basically. So the next ratio is the debt to asset ratio, and this ratio will help you tell the percentage of a company's total assets that is actually financed by creditors or debt. This is calculated by taking total debt divided by total assets. Another really common ratio is also the solvency ratio, and this ratio actually helps measure a company's ability to repay all of its long-term obligations. So how it's calculated is you take net profit after tax, you add back depreciation, and you divide it by total liability. The next financial statement is going to be the income statement, often referred to as the profit and loss. So the income statement will show a company's revenues, expenses, and net profit over a period of time. The income statement will help you track your profitability over a specific period, and it's really, really important to be able to track your profitability because that's going to help you gauge your budgets, your forecasts, and to see if you're actually on track with your business's goals and if it's aligned, and making investment decisions as well too. So on the income statement, starting at the top, you're going to see revenues, which is basically your top line sales. Next, you might see cost of goods sold, and cost of goods sold is basically all of the direct costs you incurred in order to produce that product that you're selling or produce that service. Depending on your business model, you might not even have any COGS. When you take revenues and you minus the cost of goods sold, then you have gross profit. Next, you will have your general and administrative expenses. All of the expenses here are incurred to operate the business. So for example, your rent, insurance, utilities, meals, entertainment, salary and wages, etc. Once you take gross profit, you minus your operating expenses, now you have net income from operations. So depending on your business, you may or may not have other income or other expenses, which are kind of more like one-time incidental items. So for example, let's say you sold a piece of equipment last year and you resulted in a $1,000 gain. Then you'll throw it on the bottom here because it's one time and it's not routine. Basically, after you take your net income from operations plus minus other income and expenses, then now you will have your net income before taxes. Next, you're gonna have your income tax expense, which would depend on whether you're accruing for it or your year-end accountant will help you with. And then after that, you will have net income, net profit. Woo! So now that you know what is on an income statement, how do we use information on the income statement to assess financial health? Well, some of the ratios that can be calculated are basically taking any income statement line items and dividing that by total sales. So for example, the first one that comes to mind is gross profit margin, and let's do an example. So for the gross profit margin here, you basically take gross profit, so 133, you divide that by total revenues of 220, and then you'll have a ratio of 60%. That is your gross profit margin. And what that means is that for every dollar that you generate in sales, you get to keep 60% of that after cost of goods sold. So thinking about it inversely, for every dollar you generate in sales, 40% of that is going to be paid to cost of goods sold. Basically, 40 cents on the dollar. So we could also use this for net profit, right? Your profit margins. So if we go to the very bottom after income taxes, let's say your net income is 39, top revenue is 220 to 20, then you'll have a ratio of 18%. And so what that tells you is that for every dollar of sales, after deducting operating expenses, cost of goods sold, income taxes, you get to actually keep 18 cents on the dollar. So you get to keep 18% of that. So it's really important to be aware of your profit margins to see how much wiggle room you have, how profitable you really actually are. And it's really helpful to identify areas where you might be overspending. So this is a really good metric to know and to keep in your toolbox. So the next financial statement is cash flow statement. So do you ever wonder why your business brings in a lot of sales, but it seems like you never have enough cash on hand available for you to buy business equipment or to deploy that? Well, first, it's really important to differentiate profit versus cash flow, right? So your company might be really generating a lot of sales and can be very profitable, but cash flow is really dependent on the timing of when you actually collect the cash from your sales and when you actually pay cash out for your business expenses, right? So it's really important to know your cash flow position because it'll help you make decisions. So for example, like, should you buy the new iPhone outright, or should you finance it for the monthly smaller payments for a cash flow perspective advantage? The cash flow statement summarizes what happens to a business's cash during a specific period of time. The cash flow statement also summarizes the net inflow or the net outflow of various activities. So the first category is operating activities, and this is basically the cash inflow, outflow in the change of current assets, current liabilities, your income and expenses. The next is investing activities, which is basically the cash inflows and or outflows from purchasing or selling assets. The next activity is financing activities, and this is the cash inflows and outflows through debt financing and equity financing. So for example, it'll show if the company paid out dividends to shareholders, it'll show the net cash outflow. If you received money from a bank loan, that will be debt financing, so that's going to be part of your cash flows for your financing activities. The statement of cash flow will basically tell you if you're in a positive or a negative cash flow position, but keep this in mind. Just because it's a negative cash flow situation doesn't necessarily mean it's always bad. You have to view everything holistically. So the main takeaway here is that financial statements will help the reader assess the financial health of a business, as well as providing a summary about the business's operations so that the reader can make informed business decisions. Let me know in the comment section below if you guys want me to make a separate video taking a deeper dive into each of the financial statements, because today we barely touched the surface. If you found today's video helpful, please make sure to give it a thumbs up and make sure to hit that subscribe button. On this channel, I'll be posting up more important accounting tips and tricks for entrepreneurs. Thank you so much for watching to the end of the video. I'll see you next time.